Before we get started, just want to give you a little background on myself for those of you who have not met me before. My name, of course, is John Vento. I'm a certified public accountant. I'm also the president of Comprehensive Wealth Management, a New York City-based CPA firm as well that specializes in working with dentists across the country. I'm insurance licensed, I'm securities licensed, pretty much anything investment, tax, accounting related. If it's financial related, I got you covered. Throughout this presentation, I'm going to encourage each of you to take notes. Note down what your question is so that you'll have an opportunity to reach out to me and speak with me about what your particular question was. Please call my office. Contact information is at the bottom of the slide. Okay, so we're going to turn now to tax planning strategy number 7. And I have to admit, the topics that I just covered was kind of intense. The next 2 topics are going to be pretty intense as well, but they are such powerful tools. So I hope that you pay close attention, take some notes, and like I said, call me if you have questions, which I'm sure you're going to have questions. So let's talk about 1031 exchanges. I'm going to read the slide to you. Section 1031 of the Internal Revenue Code provides an effective strategy for deferring capital gains tax that may arise from the sale of business or investment real estate property. By exchanging real property for like-kind real estate, real property owner may defer taxes and use the proceeds to purchase replacement business or investment property. Like-kind real property includes business and investment real property. So by business, we mean business real estate and investment real estate. It does not include your personal home. 1031 exchange, extremely powerful tool. So let's assume for a minute you sell your dental practice, but you still own the office building and you decide you're going to collect rent on that property. There may come a time that you don't want to own that rental property anymore. Maybe you're concerned that the neighborhood that you were in when you were working is going downhill. Maybe you're concerned that the dentist that you sold the practice to doesn't know what they're doing and they're driving the practice down and they're going to struggle paying rent. So utilizing a 1031 exchange would allow you to sell your property, your office building or multifamily home, any investment type property. You could sell it, and even if you have a tremendous gain on that property, you're not going to pay taxes on it as long as you use that money, the amount you sold it for or more, to invest in a replacement investment property. So very, very powerful tool, and I'm going to go through some of the rules that relate to that. From an estate planning point of view, 1031 exchanges are also terrific tools because what happens is as long as you do a 1031 exchange, you'll avoid paying the capital gains tax on the sale of your dental practice office building. Then eventually that replacement property that you bought, you'll continue to own that as long as you own it through death and then you pass away down the road. Once your children inherit that property from you, not only have you deferred the tax, but that deferred tax now becomes tax-free because once you pass away, they can't get you for that capital gains tax. And here's the kicker. Your children, their cost basis, based on the current tax laws, goes up to the fair market value of that property as of the date of your death. So if your children were to sell the property the day after your death, they wouldn't pay a penny of capital gains tax either. So this strategy could actually allow you to permanently eliminate the capital gains tax on the sale of your property. That could be a game changer, especially if your investment real estate is one of your major investment assets. Let's get into a little bit of the nitty gritty with the 1031 exchanges. Number 1, on the day that you sell the property, that's considered day 1, seller relinquishes the property. You need to hire, before you go to closing, what's called a third-party intermediary. A third-party intermediary is typically a title company or another lawyer. Can't be the lawyer that represents you on the sale, but typically that person has to be at the closing. They have to accept the proceeds from the sale of the property you just sold and that money has to be held in a separate escrow account. If that check touches your hand and you deposit that money, all bets are off. You cannot do a 1031 exchange. So very important, make sure there's a third-party intermediary hired as part of the transaction. They must be there for the closing of the property. So assuming you do that step, that's step number one. Sell the property, don't touch the money. Let the third-party intermediary hold on to the money. The clock then starts ticking, and you have 45 days to identify the replacement property that you're going to purchase. You could have been looking for this property even a year before you sold it, but once you sell it, you only have 45 days to send a notice in writing to that third-party intermediary about which property you're thinking about buying. The nice thing is you can identify multiple properties. So if there are 3 properties you're thinking about buying, notify the third-party intermediary of the 3 properties you're thinking of purchasing. You don't have to buy all 3, but if property number 1 doesn't work out and property number 2 doesn't work out, at least you have the third as a backup. So once you identify, then that, along with day 1 when you first sold it, you have a total of 180 days to then close on the acquisition of the new property. Now, I want to emphasize, some people think you have 6 months. It's not 6 months, it's 180 days. So if you go to 181 days, once again, all bets are off. You can no longer complete the 1031 exchange. This is such a valuable strategy, I can't begin to tell you. Let's assume you live in New York and you're not crazy about things going on in New York these days. You've sold your practice a few years ago. You have this property here. You're now living in Florida because you don't want to have anything to do with New York. If you sell that property in New York and do the 1031 exchange, you can now buy another investment property closer to wherever your retirement home is, whether it's Florida or somewhere else. Very, very valuable tool. Definitely would recommend taking advantage of that. Now, a strategy that is very rarely utilized and very rarely hear people even talking about it is utilizing a 1031 exchange in combination with what's called a Delaware statutory trust. So let me read this slide to you. Maximize your retirement income utilizing a 1031 exchange of your dental office building or any other investment real estate utilizing a Delaware statutory trust, also known as a DST. So what is a DST? Well, it is a trust, and it was created in the state of Delaware. You don't have to live in Delaware to do this. You can live anywhere in the United States and still take advantage of this special provision. So let me read the slide to you. DSTs are a partial ownership structure of choice. A Delaware statutory trust permits fractional ownership where multiple investors can share ownership in a single property or a portfolio of properties, which qualifies as a replacement property as part of the investor's 1031 exchange transactions. A DST takes all decision-making out of the hands of the investor and places this into the hands of the experienced sponsor affiliate trustee. So what does that really mean? What it means is this, that you sold your property, you hired the third-party intermediary, the money is now sitting in the escrow account of the third-party intermediary. You now decide that you're going to buy a replacement property, but you know what? After all these years of having the headaches of managing a property, you no longer want to deal with that. And that's just one of many reasons you might want to do this. You don't have to purchase a property and then become the landlord of that property and deal with all the headaches that come along with it. If you're not interested in worrying about fixing toilets, throwing out the trash, it's called the 3 T's. If you don't want to deal with, the third T, I think it's termites. You don't want to deal with all the 3 T's. At the end of the day, you want to be hands-free. Then a Delaware statutory trust in combination with a 1031 exchange could help answer that problem for you. So let's talk a little bit about what are the key benefits of utilizing this strategy. Well, number one, we know we're going to save money in taxes, right? Because the tax will be deferred. One thing that more mature, that's a polite way of saying senior, dentists, one thing I've noticed a common trait is as they get older, they don't want to deal with the headaches of managing property. The government considers property ownership a passive activity, meaning you don't have to work, the rent just comes in. But anybody that owns investment real estate knows that's not the case. Basically, it becomes a part-time job for you. For a lot of people, it could become a full-time job if you have enough properties. So one of the attractive things of getting involved with a DST is that, yes, you could sell your property, but instead of buying one physical property by yourself that you're going to be fully responsible for, you're going to do a 1031 exchange into the DST, and you'll be part of a much bigger group of people. Best analogy I could draw is like a real estate investment trust where you put your money in, there's multiple properties owned, and there's thousands of people that own it. With a DST, there's much fewer people that own it, but the best part is it's managed by a separate party, not you. The other big thing is when you're looking at a DST, you have access to institutional quality properties. And what does that mean? Let's assume you sold your building for $1 million. There are plenty of properties I guess you could buy for $1 million, but they're not going to be the top rated properties. Typically with a DST, if you're looking at residential real estate, it could be 300, 400 unit development, let's say in Florida. It could be in Baton Rouge, Louisiana. It could be in different parts of the country. The point is these locations, by ourselves, we can never afford, at least most of us couldn't afford, to buy these very large buildings. When you do have a large property, the economies of scale make them typically a lot more profitable. So you'll own a fractional interest in a much, much bigger property that otherwise wouldn't be available to you as an individual investor. You also get the limited liability protection similar to an LLC because it's set up through a trust. The other thing that I'm a big fan of is the diversification factor. So again, I'm using New York as an example because that's where I'm from. Assuming I live in New York or you live in New York and you're a dentist and you own 5 investment real estate pieces of property, if you're concerned about the direction of this state and city and you see property values going down in the near future, well, you know what? It may not be a bad idea to sell one or more of those properties and diversify your risk. Not only diversify it by asset classes, right? You don't have to buy an office building with that money. You could buy an apartment building. You could do self-storage units. I would stay away from office space and retail space because I think in the coming years, those asset classes in real estate are going to have a very, very difficult time based on the new norm, the new economy that we're in. But my simple point is you could diversify by asset class, but even better, you could diversify by geographical location. So instead of having all your real estate and all your eggs in one basket in your local neighborhood or town, now you can own a fractional interest in real estate literally anywhere across the country, depending on where the properties that are held through the DST are held. Huge, huge benefit. The estate planning benefit from this, the term that we like to use is swap until you drop. So once you go into a DST, there will come a point where that property will be sold and there'll be a liquidating event. So now you're going to get that money back. What you're going to do is rather than taking the money and now getting stuck paying the capital gains tax on it, you're going to set up yet another 1031 exchange, whether it be 5 years or 7 years or 10 years down the road, and you'll continue to swap, do a 1031 exchange, literally until you drop, because the strategy here is going to be that ultimately you want to get all the income from that property as you're earning it every year, but ultimately you want to still own this upon your death to permanently avoid the capital gains tax, not just to you, but to your loved ones, your beneficiaries, the legacy you're going to leave to your children, if that's who you're going to leave your money to, will be much greater because you avoided paying this huge sum of money in taxes, and now they receive that money completely income and capital gains tax free. So definitely something to think about. If any of you have questions about how to utilize a 1031 exchange with or without a DST, by all means, just give me a call, schedule some time, and we'll talk about it. So this is the cover of my book, Financial Independence, Getting to Point X. I would highly recommend that you pick up a copy of it. It could be ordered through Amazon.com or Barnes & Noble. The book is loaded with useful financial planning tips. In addition to that, the second version, which is the green covered book, has a new chapter dedicated to dental practices and the specific strategies you could use to save more of what you make. So with that said, once again, thank you for attending the presentation. I'd like to wish each of you the very best of success. Have a great day and enjoy.